This may say more about my ignorance than a sort of prevailing reality, but if 5 years is now considered the very long term, I mean, what does that tell us about the sort of the wisdom of the markets?
Yeah, well, I don't think there is any wisdom of the markets in the short term. So we're, you know, what you see in the markets is just this incredibly higher amount of volatility in share prices than any fundamental justification. You know, a company is not usually worth 10% more next month or less than it was yesterday. That's because far too many market participants are just speculating against each other. So this whole quarterly performance and even annual performance measurement, both within companies and performance for asset management companies, is all just noise. Certainly up to 3 years. 3 to 5 years is a bit more mixed evidence. 5 years plus, there's very strong evidence that companies with the best operational performance and earnings growth are also the best performing in share price terms.
Okay, but we can all call something broken. Brass tacks, what needs to be done to fix the investment management industry?
Yeah, so there's a lot. Well, lots in the investment industry, but it goes deeper than that. So there's a whole chain of agency issues right through. So you have to start, you know, within companies. You've often got management who are incentivized on relatively short-term profitability, earnings per share. That's how their bonuses and incentives work. That can lead them to forgo positive NPV projects because it's going to depress short-term profitability. Because the market's short-term, they're going to mark down a share price because somebody made what arguably is a good investment. So you've got this terrible vicious circle of nobody thinking long-term because they're anticipating how everyone else is going to react to that. So it's really an alignment thing. And then within the investment industry itself, we have created this apparatus where we have a quarterly reporting cycle. We report index relative performance. We don't really talk about operational progress of the companies we're investing in. It takes 5 years plus to know if companies are making great operational progress in the main. So can we create internal incentives for our industry where your fund managers are actually incentivized over those sorts of time periods? Now, we do that. I don't think there's any particular reason others can't do that other than you're in this sort of vicious circle. And there's a client element to this too. We try to be really clear with our clients. To be clear, we're not the only ones doing this. But we say to them, if you don't have a 5-year horizon, we can't really explain our actions to you. You're going to ask us, why did you underperform over a quarter or outperform? We're just going to say, there is no explanation, it's noise.
But isn't part of the problem that the industry is incentivized as much by AUM as they are by performance?
Yeah, so fundamental challenge in the industry is if firms want to get bigger, if growth is your goal, you're going to take on assets arguably beyond the point in which you can invest successfully, which likely is what led you to gain assets in the first place.
Should there be a cap in terms of how much any fund can manage?
Yeah, yes, but it depends on how the fund is managed. So I don't think you could have some sort of external cap, but what you should certainly be doing if you're allocating money to a manager is asking them how they are thinking about and managing capacity. And remember that this is an industry in which there's an imbalance between the sort of distribution and marketing angle in our industry and the sort of fundamental job of can we just try and be really good at investing? Now, if you lose focus on the fundamental investing job, what do? You hire more and more marketers to go and sell stuff. There's a much easier way to go about this, which is if you just focus on being excellent, or at least trying to be excellent, you don't then have to worry so hard about the distribution side. People will come to you, but you have to be clear with them that this is how you should measure success in our part. And sorry, on the capacity question, if you take on more assets than you can reasonably manage, your performance will suffer in the long run. So if you're thinking about your clients in the long run and your business in the long run, there shouldn't be an incentive to grow beyond the point where you can. Hard to do that if you're in the sort of public equity world of everybody wants steady earnings progression. That steady earnings progression does not work in an asset management company.
Right, but scale is very important because the number of decisions investors have to make has gone up. The expectation that they're involved in governance or environmental stuff or social stuff is ever increasing. You need to be big, surely, to actually execute that.
Yeah. Yes. So I think that's interesting. So there's a trade-off here between sensible capacity management and having the resources necessary to do a good job. So even in terms of, that relates to pricing, it relates to the commercial reality of asset management companies. I think the way we should think about it is what does it take to have a top-class research function and capabilities that you need to engage with the companies that we invest in. So this very laudable, responsible ownership, ESG zeitgeist interests me because I think it's absolutely the right thing to do. I think it's indirectly very good for the industry because it's compelling people to think longer term. But by the same token, if you try and push fees down to a point where companies can't reasonably put in place the substantial resource you need to, whether it's research function or ESG or engagement or whatever it might be, you can push fees down to a point where the sort of effective implementation of the responsible ownership thing just doesn't work very well. So to be quite clear, I'm not advocating for high fees, but there needs to be a value for money thing and not just a cost thing.
You need to pay people to make decisions, essentially. Talk to me about consolidation, because that's been a huge trend in the industry this year and looks set to continue into 2020. Is that a good thing?
I'm pretty sure it is. It may not be good for everyone who's involved in it, of course, but I think what you are seeing is, so it's back to this point about if active managers on the whole are not doing a great job delivering for the clients, what do you do in those circumstances? You raise revenues by gathering assets, by merging with other companies, and you lose some costs out the back end. The most charitable interpretation of that is you do it without making your capabilities poorer. The less charitable interpretation of that is you sort of rip a whole lot of cost out and you hope that you perform reasonably and the clients don't notice for a while. So you get a short-term pop in profitability. So I think there's a lot of that going on. But the fundamental point, if the asset management industry was significantly smaller than it is at the moment, I don't think there's any great loss in that.
I promised myself I wasn't going to ask you an Elon Musk question because I've done it all too often.
Okay.
But you raised the point about institutionalized management and the sort of perils of. At the other end of the scale, you have individuals like Mr. Musk. You guys have been a huge backer of one of the largest holders in his company, Tesla. Is there a sort of happy medium between the institutionalized management on the one hand and the sort of more, if you like, non-traditional management style, someone like Elon Musk?
I think that's an entrepreneurialism question. So, yeah, we've spoken a lot about that particular example. I think what you have to recognise is that people who are trying to achieve great things are almost certainly going to be a bit unconventional. You know, to try and do what he's trying to do, you need to be an extraordinary individual. It's not really realistic to expect extraordinary individuals to be sort of conventional corporate management. So we're pretty relaxed about that. I mean, we often say to ourselves internally, we're not actually the smartest people. The smartest people are those who are building fantastic companies and dreaming of the future and trying to change the world. Now, you know, that's, if you're going to try and back people like that, you're going to have to take their character.
But if everything you said is correct about the way the industry, the way the investment industry is today, surely it's not set up to actually recognize or even account for the qualities of someone like Mr. Musk and his companies.
No, probably not. So I would sort of put that in the governance box in the widest sense. So what's often interpreted as, you know, we'll vote and we'll engage a bit, particularly on ESG, but governance is a different thing. For us, governance is about working constructively with companies that we're investing in. And one of the real ironies of this is to give you an example. If the market on the whole is short term and management of companies respond to market short termism by acting short term, one of the most valuable things we can do as quote unquote actual investors is encourage management to ignore what everybody else is saying to them. You know, so do not worry about the short-term consequences of this decision that somebody wants you to make for the wrong reasons. Focus on what's happening 10 years down the track. We love companies that are reinvesting heavily in their own future, even at the cost of short-term profitability, because as long as that's done well, that surely is how wealth is created in the long run. So we often find when we talk to management of companies, they, I hope this is true, they like talking with us because we do not ask them, are you going to hit next quarter's earnings? We're just not even interested in that.